Hello, and welcome back to the Lazy Money Game. In today's episode, we will see what has happened in the stock market through my portfolio and, of course, answer some questions from the audience. So the first thing you immediately notice is column H. Every single holding is down in value compared with last week. In fact, I only have one holding which is still in positive from when I bought it. In fact, the drop is so severe that we haven't seen a decline in the S&P 500 of this magnitude within a week since 2008. So apparently the coronavirus is affecting the market more than we initially thought. So how can we deal with this within the portfolio? What should we do in order to protect the portfolio and protect our investment going forward from this point on? Since the coronavirus is now spreading more than we initially anticipated, it's starting to upsetting the supply chain and shaving the sales of some products, throwing travels into chaos. And that is of course freaking out the stock market and intensifying the fears of a global recession. And since China now makes up a much larger share of the world economy than it did back in 2003 when we were hit by the SARS, companies like Nike and Apple and other manufacturing companies are already admitting that they are severely hit by this virus. And of course other industries like the travel and tourism, so for instance airlines and cruise lines and hotels, are also severely hit by this outburst. This can easily be identified within my portfolio since I for instance hold Carnival Corporation, which is currently down more than 25%, and Thursday it was actually down more than 30%. And even if the coronavirus will not spread more widely than it has already done, we might see a change in the global economy, that some of these manufacturing companies would be less willing to rely so heavily on their manufacturing in China and actually trying to diversify their manufacturing process. So all these issues with the supply to all the manufacturers and the issues with traveling, we can deal with it if it only lasts for a couple of weeks, but if this goes on for months and months, then all the suppliers won't have anything left in their warehouse, and that will definitely affect the global economy heavily. So that is basically why we are seeing these massive drops in the stock market, because there is now much more risk than there was a week ago, 2 weeks ago, and no investors like risk. We really want to have a premium if we are to take more risk. And what we also see from the news is that Goldman Sachs and JP Morgan is out and cutting profit estimates for the S&P 500, meaning that they are expecting all the companies in general to earn less within 2020. How much is of course the question which no one yet has the answer to. So how should you react as an investor in this scenario? Basically, if we look at the two scenarios where you say that the coronavirus is only for short term and we would expect that we have a cure soon and we have it under control, then you should start buying today. If we expect that the coronavirus will be spreading more widely and it would cause more hassle and more interference with the supply chains and more closure of stores, then perhaps we should wait a little longer before we start investing. So what did I do to my portfolio within the week? Well, I went out Monday and I bought some shares in Carnival Corporation, $240 I invested. Little would I known that it would have actually been a much better idea to wait until Thursday, but I couldn't have foreseen that we would see such a severe drop in the market. On Wednesday, I went out and acquired an entire new holding. I have invested $2,000 into Pfizer. They are mostly known for being the company which produces Viagra. So in total, I have added $2,240 into the portfolio. Despite this, the portfolio value is still severely down compared to last week. My portfolio is down more than 14%. And if you are a new investor, this would of course give you the natural reaction of panic, and it might even trigger you to say, I have no clue to what I'm doing, I simply do not understand this, I'm going to sell it all and just live with the loss, and admitting to myself that I do not understand this and will stay off of the market for good. So this is where you have to remind yourself that you are in this game for the long run, because there will be big fluctuations in the market. It will never go in a straight line. It would be more like a random walk. So what I have done and what I will continue to be doing is known as dollar cost averaging. Simply trying to buy all the way down and all the way up, and acknowledging the fact that I won't be able to know when we hit the exact bottom. So depending on whether you're leaning towards scenario 1, you might be willing to add more risky stocks to your portfolio, or if you lean more towards scenario 2, where you would expect the coronavirus to severely affect the market and perhaps or potentially put it into recession, you might want to consider buying better credit quality companies, meaning companies who has a low debt ratio and would be much better suited to withstand a recession. Or, to quote Warren Buffett, only when tide goes out do you discover who's been swimming naked. So that was a lot of focus on stocks dropping in value. Now let's take a look at some of the positive news within the portfolio for this week. I have received an email from Seeking Alpha where Macy has declared a dividend which is in line with previous. Meaning that even though the stock is down more than 22%, they are still able to deliver the dividend which I have hoped for, and that is really positive news. So this just once again proves the point of investing in dividend growth stocks. The dividend is not growing in this case, but despite the fact that the stock is down more than 22%, it can still pay its dividends, and those dividends can be reinvested, meaning that I will actually get a larger portion in that particular company if I decide to reinvest my dividend within Macy's. So let's try and look at some of the questions that I have received. Hey, the Lazy Money Game, can you try and explain these questions about money? The 5 biggest lies about money. So if we start by looking at question number 1, you need a lot of money to start investing. Hopefully, after I've been following this channel for just the first 6 episodes, you will know that this no longer holds true. You can actually get started with as little as 100 Danish kroner. Question number 2. Investing is complicated and only for the wealthy. Well, of course it requires some knowledge, but I truly believe that it is possible to learn all the necessary things in order to start investing. So if you follow this channel, hopefully you will feel much better suited in order to start your own portfolio and in order to grow your own wealth. But I won't lie, it will require some work, probably a lot of work if you do not know anything about investing in the beginning. But once you have done that initial work, you can really begin to see the benefit. And I think the reason why question number 2 says only for the wealthy depends on your definition of wealthy. Of course, you need to have all your basic needs covered and have some surplus in your budget so you actually have some money that you can invest. But it's not required to have $1,000 or $10,000 that you can put aside every month in order to get started. You can actually start with as little as 100 Danish kroner. Question number 3. You're throwing your money away on rent. Everything else equal, that statement is actually true. But I think it's a bit more complicated than that. For instance, if you're considering buying a home, then you most likely will have to go out and borrow some money, and that will put a huge constraint on your economical freedom. So, Some of the factors that you need to consider if you're going to buy a home is: how much do you have to borrow? What rate will you be borrowing at? How about maintenance, repair, insurance? What is the location of the property? Is it likely that that home will actually increase in value? So if we look at it from an investment perspective, you have to look at the time horizon. How long do you actually expect to live there? Will you be able to hold the property until it's actually beneficial for you to sell? Meaning that your economy should be of such a nature that even in case that you lose your job and don't have an income for, let's say, 3, 6, or even 12 months, that you won't be forced to sell. Because if you put yourself in a position where you are forced to sell, then you should really consider not buying in the first place. So that actually also covered question number 4. Student loans are good debt. Well, that really depends on what you spent that money on. For instance, I'm living in Denmark. There we are actually paid to take an education because the government considers it to be an investment. So if you take up a student loan to pay more attention to your study and invest in yourself, or for instance, be more liquid so you're able to buy a property once you have finished your education, that wouldn't be a good investment. But if you are considering to take up a student loan in order to live like you're already rich, meaning that you want to travel 4 times a year and you want to have the newest and fanciest clothes, then from an economic perspective, that is really not a good investment. So that concludes yet another exciting week on the stock market. I have of course included some links in the description below. For instance, there's a link to the random walk, since that's a mathematical concept that maybe some of you are not familiar with. And I have also included an updated version of the Google Sheet, since I have added a new holding, so I thought that might be of interest to some of you. So that was it for now. So remember to comment, like and subscribe, and feel free to ask questions. I will include them in some of the future episodes. Bye!